Good afternoon, everyone. Thank you for joining today's Q&A session addressing the recently passed CARES Act and other financial relief programs in response to the COVID-19 pandemic. I'm Bob Sharon, partner in charge of Friedman LLP's tax department, and I will be moderating today's program. While many of you have been in the workforce for decades or involved in long-standing businesses like Friedman has, we've been around for nearly a century. These are unprecedented times for all of us who have never experienced a global health and economic crisis of this magnitude. The coronavirus pandemic continues to send shockwaves throughout the world economy, business community, and families across the globe. Our thoughts are with all those who are suffering, and we continue to wish for the well-being and safety of you and your families. In response to the pandemic, Friedman has formed a COVID-19 task force of dedicated CPAs and advisors to keep you up to date and informed of the various programs and measures put in place by federal, state, and local authorities, as well as taxing authorities, and how these measures can benefit you and your business. As always, we are here to offer guidance and support, and will continue to do so as the situation evolves. Thank you today for the attendees submitting questions in advance. We received 110 questions, and we will be addressing your most frequently asked questions and concerns. To the extent there is time at the end of our session, we will answer additional questions that came in during the live Q&A. If we can't have time, we will endeavor to do so. At this time, I'd like to introduce my fellow colleagues who will tackle these questions. Mike Greenwald, partner and business entity tax practice leader. In a career spanning more than 35 years, Mike has served a wide range of industries. He is also a member of the American Institute of Certified Public Accountants Executive Tax Committee. Mike Sacco, partner, provides accounting, auditing, and business advisory services to numerous privately held companies and their owners. Mike has 20 years of experience and is instrumental in helping clients develop strategies that lead to sound financial decision-making. Last, we have Alan Goldenberg, principal and member of Friedman State and Local Tax and Tax Controversy Groups. Alan focuses on tax transactions, including structuring, advisory tax services, and tax controversies at the audit, administrative, and judicial level. He has more than 15 years of experience representing taxpayers before the Internal Revenue Service and state and local tax authorities. At this time, I am pleased to turn the program over to Mike, Michael, and Alan, who after a few summary remarks will address the questions that were posted by our attendees.
All right, thank you, Bob. I'll go first. I wanted to give a breakdown and a summary of the, an understanding of the Paycheck Protection Program, which is something that's on everyone's mind. It's really a hot topic right now here at Friedman. We've been dealing with questions from clients, and we're doing our best to answer everything. I'm going to go through a summary of it, and then a lot of the questions will also be relating to this program. So the CARES Act allocated $350 billion to this program. So questions like who's eligible, how much can I borrow, can it be forgiven? I want to kind of summarize it here a little bit so everyone has an understanding. So who's eligible, right? Small businesses with 500 or fewer employees during the covered period of February 15th through June 30th, 2020 are eligible. Some industries may qualify with more employees depending on the SBA's applicable size and standards. Their website has a great table size standard that you can go to, and it shows by industry which industries allow more than 500 employees. It also is eligible individuals who operate as sole proprietors and independent contractors and self-employed individuals. Also, any business that employs not more than 500 employees per physical location if they're in the food service business. Along with small businesses, non-profit organizations are also eligible. How much can someone borrow, right? That's another big question that we get asked. The loan is up to $10 million. It's based on a formula. The formula is essentially 2.5 times the average monthly payroll incurred within the 1-year period before the date on which the loan is made, plus certain other costs. So for example, it's your average monthly payroll, and then you include certain other costs. You include wages, commissions, similar compensation, cash tips, vacation pay, severance pay, health insurance premiums for group healthcare benefits, and also retirement benefits paid by employers. What is excluded from this payment? this calculation. Basically, any employee with salary in excess of $100,000 has to be brought back down to $100,000 for the sake of the calculation. What can we use the money for? So the money can be used for payroll costs, healthcare benefits, health insurance premiums, interest on mortgages, but not principal payments, just interest. Also on rent and any leases. The forgiveness component of this is very important. That's really the most attractive part of this SBA loan compared to other SBA loans that are available. Loans are forgiven if employment and wage levels are maintained. Okay, so the amount of loan forgiveness is calculated in two ways. All right, it's basically calculated on a headcount formula and also on a total wage formula for certain periods. So I'll go through it just briefly, and then we can answer, some of the questions are relating to that. We'll answer them. For reductions in the forgiveness of the loan for employee headcount, the calculation is as follows. Right, the average number of full-time equivalent employees per month for the 8-week period beginning on the date of origination of the loan, divided by the average of full-time equivalent employees per month during the period February 15th, 2019 through June 30th, 2019, or at your choice, the average number of full-time equivalent employees per month during January and February 2020. So the loan forgiveness is reduced by the percentage of that formula. The second wage test, the second reduction to the loan forgiveness is reduced by any reduction in total salary of any employee during the 8-week period beginning on the date of the origination of a loan that is in excess of 25% of the total salary of that employee during the most recent full quarter, right, during which the employee was employed, which that would be the first quarter of 2020. So for the purpose of that calculation, anyone whose annualized salary for 2019 was greater than $100,000 is not included in that computation. And that's a dollar-for-dollar reduction of the loan forgiveness. There is a cure period. All right, the cure period is for reductions that occurred between February 15th, 2020 and 30 days after March 27th, 2020. March 27th was the enactment date of the bill. As long as released employees are rehired or salary reductions are reversed by June 30th. The portion of the loan that's not forgiven becomes a 10-year maturity with an interest rate of no greater than 4%, and you have an option to defer payments of interest and principal for not more than 1 year. Some of the key points to discuss about this loan is, number one, there's no personal guarantees required for the loan. Loans are non-recourse to the company unless proceeds are used for an unauthorized purpose. The lender will not consider the borrower sought and was able to obtain credit elsewhere. There's no collateral. The loan forgiveness is not taxable. There are two other things in the law that we'll go through later on, but it's a lot of people know the payroll tax credit and payroll tax deferral. Those cannot be combined if you use this loan. Also, there's going to be a good faith certificate required when you file the application. There's also an economic injury disaster loan that's available through the SBA. So if you already applied for that loan, that's fine. If you can't have both, but if you apply for one and you get it and you apply for this loan, the first loan will be refinanced into this loan. You can't have both loans under the same tax identification number. The biggest question we get from everyone is, where do I apply? How do I apply? And when do I apply? So right now, the loans are going to be made available through eligible FDIC lenders. So right now, all the banks are working on putting together their application process. They're working with the SBA. We anticipate over the next week that all the banks are already, I know a lot of the banks are already reaching out to their clients and letting them know that this is going to be available and what they should start doing to prepare for it. So you should, at this point, you should reach out to your bank and see if they're going to be participating and what you would need to get ready in the meantime so the application process goes smooth. That's really the best thing we could advise right now is reaching out to your bank to talk about this. Some of the things you want to consider putting together now and having ready for the application process is really organizing your payroll records, right? We anticipate the banks are going to ask for your 2019 payroll reports because it's the monthly average calculation is based off of 12 months from the time you take out the loan going backwards, right? So have your 2019 payroll tax reports, filings. You want your payroll tax filings, your payroll reports, any document showing your health insurance premium payments for group healthcare, your retirement payments, funding paid by the employers. You want to have all this information ready to go. So when the time comes that your bank opened up the application, that you could immediately get it submitted. And obviously, hopefully the funds get released very soon and everyone can start taking advantage of this. That's kind of a summary of it. We'll answer any questions that you have. I know there's a lot of good questions that came in. So that's the loan forgiveness, the Paycheck Protection Program part of this. Michael Greenwald will talk about some of the tax things that were in the bill. I think he'll give a summary now, right, Mike?
Thanks, Mike.
Yep.
So, as Michael said, the main attractive portion of the CARES Act for most businesses is this Paycheck Protection Program loan. But there were some other things that were in there that are going to benefit a lot of businesses. The big one from a certain standpoint is the employee retention credit for employers that are closed or have reduced revenues as a result of the COVID-19. So it's a refundable payroll tax credit. It's equal to 50% of wages paid by employers to employees during the crisis. You're eligible for this if your operations were fully or partially suspended because of COVID-19 related shutdown orders, or if your revenues, your gross receipts declined by more than 50% on the quarter this year to quarter last year comparison. You're qualified based on two criteria for this credit. So if you have less than 100 employees, then you can apply all qualified wages for purposes of this credit. If you have more than 100 employees, it's only wages paid to those employees who aren't providing services due to COVID-19 related circumstances. The credit applies to all wages paid between March 13th and December 31st, 2020. It's a maximum of $10,000 of compensation per employee, including health benefits, and it's a direct credit against the payroll taxes due. One caveat, if you use this benefit, you are not eligible for the payroll protection plan loan. So you have to look and do the analysis and see which one is better for you. There's another employer payroll tax benefit, and that's the deferral of payment. The employers are allowed to, and this is for any employer, regardless of whether you're affected directly by the shutdown or not, and for any amount of employees that you have. You can defer paying the 6.2% employer portion of the FICA tax. That's for all payments now through December 31st. That will have to be repaid. It's repaid in two installments, one on December 31st, 2021, one on December 31st, 2022. It's essentially an interest-free loan from the government. If you take part in this benefit, you are not eligible. You can participate in the Paycheck Protection Program, but you're not eligible for the loan forgiveness under that program. And this delay in payment also applies to self-employed individuals, but only to the extent of the 6.2% of the Self-Employed Contribution Act payment. So again, self-employed individuals can defer paying their share of their 6.2% share of the payroll tax until 2021 and 2022. A couple of other tax benefits that are in the CARES Act bill. We now have carryback of NOLs again. So any NOLs that arise in 2018, 2019, and 2020 can be carried back for 5 years. It also temporarily removes the 80% taxable income limitation on NOLs. The excess business loss limitation, for those of you who are aware of that limited excess business losses to $500,000. That's now eliminated for 2019 and 2020. Be aware that this came with a price. So for 2021 to 2026, the excess business loss limitation is 0. There's also been a modification to the calculation of allowable business interest expense. The number for corporations is now 50% of adjusted taxable income. Corporations and individuals. For partnerships, it's still 30%. I guess they figured that partnerships had already filed their returns. You can, if it's been more beneficial, use the 2019 adjusted taxable income in calculating your 2020 business interest expense. And finally, in the CARES Act, they cured one of the problems from the original TCJA bill in 2017 and restored 15-year depreciation for qualified improvement property. We're not entirely sure how that will be corrected because it's retroactive to 2018. So we're going to have to wait for guidance from the IRS on how to fix 2018 returns, particularly for partnerships. There's also a glitch for certain taxpayers who elected to use the alternate depreciation system so that for real property trade or businesses, so that they wouldn't be subject to the excess business interest limitation. The real property trade or business election to use ADS is a non-revocable election. So we're gonna again have to wait from guidance from the IRS to see how they're gonna handle that. Now, there are a couple of other things that were in effect prior to the CARES Act, and those were some credits that arose during the Family First Act, which provided for paid sick leave for workers and expansion of the family medical leave. There are some credits that are available to employers for that. There's a refundable sick leave credit up to $511 per day for a total of 10 days. There's a child leave credit capped at $200 per day up to $10,000. The IRS is in the process of providing for prompt payment of those amounts. We're waiting for guidance. It's supposed to come out sometime this week as to how employers will be able to get those credits if they don't have sufficient payroll tax liabilities to enable them to just keep the payroll taxes that they would have otherwise paid. So again, hopefully we'll have an answer on that sometime this week. Alan, you want to inform us on what's going on locally in the states?
Sure, thanks, Mike. When it comes to the stimulus in the states, it's a little more problematic or limiting because states have more budget constraints than the federal government does, and the states can't print money in the same way. They're required to stick within balanced budgets. Some states don't allow deficit carry forwards. So there's a limit as to how much the states can really provide in their grant and loan programs, but nevertheless, there's some good ones out there, particularly in New York City and New Jersey. And for our listeners here, since many are based in the tri-state area, I think these are important things to look at. And they're not mutually exclusive. So if you do file for any of the federal programs, you can also file for these programs as well. New York City has two good ones. The first one is the Small Business Continuity Fund. It is a loan for businesses with less than 100 employees that have experienced a reduction of 25% or more in revenue. It is a zero interest loan up to $75,000. In addition, New York City also has the Employee Retention Grant Program. It's for businesses with less than 5 employees, so 1 to 4 employees, also that have a 25% or more reduction in revenue. The grants are up to 40% of payroll, up to $27,000. Then New Jersey over the weekend just came out with a number of options. This was just signed into law on Saturday by Governor Murphy. Their programs are being done through the Economic Development Authority. The first one to keep in mind is the Small Business Emergency Assistance Grants Program. That's for businesses with up to 10 full-time employees that have a 20% drop in revenue. It's really geared towards certain industries such as retail, entertainment, the arts. And that is a grant program of $1,000 to $5,000 per employee. Now it's limited, the funds in there are up to $5 million. So it's something that for those who think it may apply to them to really jump on that soon. In addition, there's also the Small Business Emergency Assistance Loan Program. That is for businesses with less than $5 million in annual revenue and a 20% decline in revenue currently. It is a $100,000 direct loan. over 10 years, the first 5 years are 0% interest. The next years 6 through 10, up to 3% interest, with the first 12 months being deferred. Again, there's $10 million in that program. Applications, I believe, will be opening at the end of the week. So it's something that for those New Jersey-based businesses that are good standing with the tax authority to really consider. And with that, Bob, I'm going to throw it back to you. I know we have a lot of listeners with many questions, so we can get the program started.
Thank you, Alan. In fact, we're up to 253 questions. Obviously, we will not be able to get to all of them in this particular program, but we're going to try to consolidate as many as we possibly can. And some of the real long questions we'll probably skip so we can do 2 or 3 questions instead. And let's start with Michael. Are there any exceptions to not reducing number of employees or payroll to be eligible for the loan forgiveness? For example, what happens if an employer, it says employer in the question, but employee quits? What about firing someone for cause? What if an employee passes away, et cetera, et cetera?
And the effect would be, it's like reducing compensation. So any reduction there would affect the loan forgiveness.
Mike, can you apply for more than one type of loan, and how does that affect eligibility?
So you can apply. So a lot of our clients have already applied for the EIDL loan. So you could certainly apply for that loan, and it doesn't disqualify you from applying for the Paycheck Protection Program loan. Well, what happens is if you apply for the Paycheck Protection Program loan and you're approved for the EIDL loan, which is the Economic Injury Disaster Loan, the Economic Injury Disaster Loan will be refinanced into the Paycheck Protection Program. I mean, some of the major differences between the 2 loans are the Economic Injury Disaster Loan is up to $2 million. There could be personal guarantees in it. It will have recourse. They're going to go through the full, as if you were going out for any loan. They're going to look at your financial condition. They're going to look at through the owners, look at their finances. And there's no forgiveness component to it. So a 30-year loan. So basically there are differences between the 2. And if you get both, you just have to refinance the EIDL loan into your Paycheck Protection Program loan.
And as of right now, Mike, there's no maximum amount of EIDL money that's out there, but there is a maximum amount of the PPP money that's out there. Once that $349 billion is gone, unless Congress, appropriates more, that's going to be it.
Yep, correct.
Michael Greenwald, a number of people have asked a similar question. Do distributions taken by members of the employer LLC who file partnership returns constitute payroll costs?
Not as far as we know, and from what we've seen from the information that the banks seem to be getting ready to request, they're not including that, although they are, or some of them seem to be including contributions to retirement plans for partners in partnerships. But the actual distributions or the actual distributable share of partnership income or guaranteed payments to partners does not seem to be an item that would be included. And if you think about it, it would be inequitable to say that the net income of a partnership all of a sudden all becomes compensation, even up to $100,000. So far that's not in the formula, and it's not how we read the statute. But we're expecting guidance from the SBA sometime in the next few days or a week. We're expecting applications from the bank, and I would go by whatever your bank says is what they're including in the formula. I would go by that.
Mike Sacco, in regard to limits on loan forgiveness, will a small business suffer a reduction in the amount of loan forgiveness if it reduces the number of employees temporarily, but rehires all such employees no later than June 30th, 2020?
So there is a cure. So they're right. So there is a cure period for people that have been either laid off or reduced in pay. So for that cure period, as long as the released employees are rehired or salary reductions are reversed by June 30th, they should be able to cure any impact on loan forgiveness.
Mike Greenwald, it appears that the calculation of the loan amount allows inclusion of employee benefits, including retirement plan costs. Do you know if there are limitations in the type of plans included or excluded? Presumably, 401k match would be covered. Would contributions to a cash balance plan be potentially covered? What are your thoughts on that?
The statute just says retirement benefits. And up until we started seeing the information requests that the banks are telling their clients, we assumed that that didn't include any actual contributions to retirement plans. The banks do seem to imply that it in fact does, and I don't think from what we've seen, they're discriminating among types of plans. So for the moment, if you're gathering data, as Mike suggested, I would gather all that information for any type of retirement plan that you might be making a contribution to, and be prepared to include that in the formula.
Getting back to partnerships, Michael, guaranteed payments. Most partnerships have agreements that call for guaranteed payments. Are guaranteed payments to partners and 1099 to employees includable in the 2.5-month calculation for payroll costs?
So first of all, the statute is silent on guaranteed payments. There is some language on 1099s, but there's a misplaced conjunction for those of you who are legislative wonks and read these things like you're reading biblical literature. But what we're seeing from the banks is that they are including compensation paid on 1099s for things other than services. So if you bring in independent contractors to work in your warehouse 1 day a week, someone you pay on a 1099, that would be fine. But if you give a 1099 to your accountant or your attorney, that would not count, at least from what we've seen so far. The statute itself is silent on both.
Right, so if you have 1099s that you have for freelance designers, salespeople, I would certainly start gathering them and have them ready to be submitted. In case the banks accept.
Question from a self-employed scientific advisor and consultant asks, what financial benefits do I have as I am not able to secure new clients' work as businesses have slowed down, including FDA-related matters?
So he can apply, they should apply for both of these programs and see which one, they have to see which program fits them best and potentially apply for either or both and see if they can merge the two. But certainly these are the two best scenarios that are out there for people.
So Mike, if they're self-employed and their profit is, let's say I'm making it up, $150,000 on a yearly basis, it's capped at 100, and then 2.5 months of the 100 is roughly 20,833.
Yeah.
Would you say that's the maximum amount of the loan subject to forgiveness that they can hope to obtain?
Yes.
Also, Mike, what banks or organizations will be administering this program, and how long will it take for funding to be provided?
So the loans are going to be administered through FDIC insured banks. So right now, I know the banks are all working with SBA in order to come up with the guidelines that they're going to look for, the application process, and some have already contacted their clients saying that they're going to be doing it. Others have not yet, but it's really going to be done through the banks. So everyone should contact their bank, like we said, and see if they're going to be doing it. Most of them are going to be doing it for their customers. So you really want to have, if you have multiple banks, reach out to both and see which one's going to be doing it. If you have a factor, you may want to reach out to whichever bank is handling your treasury management. But you want to really be able to contact someone immediately that's going to be doing it, so you can get on their list and start getting information from them, just so you can be prepared when the application process opens up. How long is it going to take? I don't know. I'm guessing by the end of this week, the bank should know whether or not they're doing it, and then they should be putting out more information on the application process.
I think just this morning, we saw applications from around 10 different banks, some of them very simple applications.
But they were indications that they were going to have the application process open, and here are some things that they're going to be requesting.
Our expectation is that most of the banks are going to be doing this online, because obviously branches aren't open, and certainly they're not expecting people to come in. So, you know, they're going to be doing this online somehow. They're going to have to get information uploaded. You know, we don't know yet what documentation they're going to request, but you know, certainly, as Mike said, you want to have you know, payroll records. You want to have 1099 records. You know, a lot of, if you're going for a year back from the loan, you won't have filed 1099s for anybody for now, you know, for January 1st through now, because those aren't going to be due till the end of 2020. So it's not entirely clear how you're going to document. And, you know, a fair amount of this may turn on, you know, companies just self-certifying and saying, you know, yes, I qualify for the loan. Yes, I have fewer than 500 employees. You know, yes, you know, here's my payroll and eligible costs. You know, and there may well be after the fact verification of the information. This money is going to go out quickly.
Yeah.
Mike Sacco, I have a four-part question here for you. I'll read the whole question, then if you want, I'll go part by part. The PPP is meant to protect employees at their regular current pay. What is the advice for if we keep employees at work at, say, 60% of the time? And then please confirm that under PPP, employees who make over 100K can still be counted, but only up to the 100K, and the rest of their compensation does not count. If a business has been in operation for less than a year, which period must it use for a reference point? Question mark, January and February 2020? Question mark. And then finally, what do you need to do by June 30th to make sure the PPP grant is not reduced? You need to have both the same number of FTEs and same overall salary. So let's go back to the 60% part, which was the first part of the question.
Right. So that's like reducing, that would be like reducing compensation. So that would affect the amount of the loan forgiveness.
And about the 100K, if somebody makes over 100K, they get to count up to the 100K?
Right. So if someone makes, when you're figuring out your average monthly payroll, if someone makes $200,000, you're going to count them up to $100,000.
And that's plus certain other things like health insurance and retirement benefits.
And then you would add in, right. Then you would add in your health insurance cost and your all the benefits and things that we were talking about, employer paid portion of retirement benefits and health insurance and group health.
And we may be repeating certain things, but again, it's a complicated law. It's 853 pages. The fact that we are almost at 300 questions right now indicates how complicated this is. So we don't mind saying things over and over again because it's important.
Yeah, absolutely.
If a business has been in operation for less than a year, which period does it use, Mike, as a reference?
So if it's less than a year, Mike Greenwald, do you have that? I don't have that in front of me. I think.
Yeah, I think they go back to the January to February period.
I think it may be.
Yeah.
Yeah, I think it's January, February of 2020.
Yeah. Right.
Yeah.
Right. That's what I think too. What do you need to do by June 30th to make sure that the grant is not reduced? You need to have both the same number of FTEs and same overall salary.
Right. So any released employees or any pay reductions that are in excess of 25% would need to be restored by June 30th to not affect the loan forgiveness.
Yeah. What's interesting is the way you read it. You could seemingly hire back anybody as long as your full-time equivalent count was the same as during the comparative periods. But if you reduce payroll, if you reduce the compensation of someone who makes below 100,000 by more than 25%, it would appear that you have to restore the compensation of that individual, because that seems to be an individual comparison. So, you know, but presumably they're still there, so it's not like you're replacing them.
A number of people have asked the question about the definition of FTE, full-time equivalency. And I believe that's a definition that's in the SBA law. And, but I think it kind of works as a generalization that if you, normal pay period is 40 hours per week, and somebody cuts back to 20 hours a week, then it's a half of equivalency.
Roughly, yeah.
Or I'm that roughly, right. Okay. Mr. Greenwald, this concerns the IRS extension on tax payments.
Sure.
The due date of the second quarter estimated tax payment now due, normally due June 15th.
It's still due June 15th. There was a bill before the House of Representatives that would have extended all the estimates to October 15th. That bill has not yet been taken up, although I will tell you that the House is working on a fourth stimulus bill, and there is every indication that that might be in there. Now, I will caveat that with the fact that if you're a self-employed person and part of your second quarter estimate is composed of the 6.2% self-employment contribution, that part is deferred until 2021 and 2022. But the balance of the payment would still, at the moment, be due June 15th. I know it's counterintuitive, but don't think of it in terms of delaying filing deadlines. Think of it as trying to keep cash in people's hands. So right now, what they're worried about is people having cash to spend today. If by June this is still going on, I would assume you'll see the same sort of delay on the payment. But for the moment, it's not a timing thing in terms of processing. It's more about just keeping cash. Alan?
Michael, I'll just tack on that New York is following that same methodology that the federal is using regarding the first quarter versus the second quarter estimate. But in terms of other states, a state like California has pushed off both estimates to July 15th. So just check your local state law to determine. Right now, New Jersey has done nothing.
So just to reiterate, because this is so counterintuitive, the first estimate that would normally be due April 15th is now due July 15th, and the second estimate is actually due before the first estimate.
Right. But don't think of it as first and second. Think of it as they're letting you keep cash now, until July, and then they'll think about June, sometime before that one's due.
Right. A number of people have suggested that maybe they'll double up on, call their first estimate double what it normally would have to be. I don't think that will work ultimately. If the June 15th is not paid till July 15th, there's still going to be a 1 month period of penalty application.
Yeah, I think by the time all this shakes out, we're going to see a lot of issues with respect to, timing penalties and late payments and the like. It's going to remain to be seen. I just got an email from one of the banks that I have a credit card with that said, if you're having trouble with the payments, we'll let you defer payments for 3 months without interest or penalties. So there's going to be a lot of things to shake out. Right now, the answer is June is still due in June, but call me June 1st.
Like Sacco, a number of people are asking this questions about PEOs. Under the Paycheck Protection Program, if a company is a participant in a PEO, is the company still allowed to borrow to cover its costs of rent, utilities, etc.?
Yes, the PEOs, if you have a PEO, that's still considered your employee for the sake of this loan calculation and the whole program.
Mike Greenwald, spouse earns $125,000. Spouse 2 earns $25,000. I interpret the act to say the family gets the full $2,400 stimulus payment.
If they file married filing jointly, then they're under the cap, the 150 cap, and they would get the full stimulus credit.
Does waiver apply to inherited IRAs? What are options if the taxpayer's already taken their required minimum distribution?
Right. So Bob, before you get to that, we didn't talk about the waiver, when we were going over the taxes. But right now, for 2020, there's a waiver if there is no required minimum distribution rules for defined benefit plans and IRAs. Those are waived for 2020. So that's what the question refers to.
Well, actually, this question, a little bit more specific, it's about an inherited IRA.
Right.
And strangely enough, the answer to that question is that the waiver does not apply to an inherited IRA. Regular IRAs, it does. Now, with respect to if the waiver applies and you've already taken your required minimum distribution, you can treat it like a rollover. So if you're within a 60-day period, you can put it back and not have to be taxed on it. If you took it like January 1st and you're now beyond the 60-day period, technically that doesn't apply because you're beyond the 60-day rollover period, but there is a strong feeling that the IRS may grant relief for that, but you can't be certain. Only certain within the 60 days. Alan, we thought we'd never get to you. How will you measure the benefits of self-employed and sub-S owners for New York State unemployment, and what information is necessary to supply them with?
So for S corporations, I think it's a little easier question to answer because shareholders of an S corporation receive W-2s for their reasonable compensation. So for that, I think it'll be a little bit easier for the state to determine the unemployment. When it comes to self-employed, members of an LLC or a Schedule C individual, it becomes a little more problematic because we don't have a W-2 on which to base the unemployment. Because it's $600 and the unemployment is a federal change to state unemployment, we're still waiting for guidance from the Labor Department on that. But nevertheless, I just checked the New York State website today as an example, and they posted there for people just to go and to register and to file now. And this way, when they process their claim, hopefully they'll have some guidance at that point.
How about unemployment by an S Corp owner who is paid into the state but historically could not collect? I think that might be a Pennsylvania situation.
Yeah, so again, I think because of S corporations and shareholders getting W-2s, it'll be based upon that, which was filed with the state. I think that's a little more clear cut. Those who are not getting W-2s, we're still kind of up in the air as to how the unemployment will be determined at the state level.
We have a question. How does this relate to the FFCRA requirement to provide full pay of 80 hours to my employees? I'm not sure we can answer that. I don't know.
I'm not sure what this refers to. Yeah.
How does this relate? Well, okay, we're moving along. Alan, what relief programs are available for Chester, New Jersey, and Morris County?
So I would advise to look at the new New Jersey programs that are out there. The Economic Development Authority, they've just loaded on their website over the last few days these programs that were released by Governor Murphy. They also have a great tool on their website, like a wizard, where businesses can enter in their information, and it will kind of provide them some guidance as to what programs they may be eligible for. I'll run through a couple that I touched upon at the beginning and maybe touch on one or two more. As I mentioned, they have the Small Business Emergency Assistance Grant Program. It's a grant of up to $5,000 for smaller businesses, less than 10 employees. It does also apply to 501c3 organizations. I saw that was a question that popped up at the on the Q&A. Also, there's the Small Business Emergency Assistance Loan Program. Again, those are loans up to $100,000 for businesses with less than $5 million in annual revenue. And then I just touch upon two more that I didn't get to. One is the Community Development Finance Institution Emergency Loan Loss Reserve Fund. It's for working capital, up to $75,000 per business. It's negotiated, but the rate has to be less than 3.75% for no more than 5 years. And finally, if we have anybody out there listening that is in a business that needs to scale up during this time. For example, a tech company, an underwriting company, a loan organization, because those are vital to a lot of the stimulus that's going on, they can get a grant from New Jersey of up to $250,000. But I would just advise that if you are in that business, there's only about $1.25 million in that program right now from New Jersey. So if you are in those lines of business, get on the website and apply. I believe the information should be up there by the end of the week as to the application process for that.
Alan, when does the extra $600 per week for unemployment benefits begin?
So last I saw, they were trying to have that released this week, or next week, I should say, starting the week of April 5th. It is tied into your state unemployment. So once you're approved for state unemployment, the $600 will go along with that. Individuals will receive 2 separate deposits, one from the state and one from the federal government of the $600. So if you're not up and running with your state unemployment by next week, there may be a delay, but remember they do backdate unemployment to the time when the job was lost. So I imagine that they're going to make up that $600, but hopefully next week.
Good. Michael Greenwald, question from someone who's obviously an accountant. Can election to be treated as a real property trade or business be changed on an amended return? For example, if bonus depreciation is more than the interest limitation.
Right, so technically the election to be a real property trade or business involves electing to use the alternative depreciation system, or ADS, for 3 classes of property: residential rental property, non-residential real property, and qualified improvement property. And we weren't worried about it because qualified improvement property, which should have been 15-year and eligible for bonus, wasn't because of a glitch in the bill. Now that that glitch has been corrected retroactively, unfortunately, ADS elections are not revocable. So we're waiting for guidance from the IRS as to whether or not they will grant blanket permission or whether they will allow the election to be revoked prospectively. But we just don't know at this point. But right now, ADS elections are not revocable. So without permission of technically permission of the Secretary of Treasury or his designee. So we'll just have to wait and see. And right now, that's not top of mind for the IRS to deal with.
Mike, talk a little bit about amending 2018 partnership return, Form 1065s.
Okay, so again, this is getting a little deep in the weeds, but technically, as the rules for partnerships changed as a result of the Bipartisan Budget Act of 2015. So as of 2018, we have a new set of rules for partnerships, and you can't technically amend a partnership return. What you can do is file what's called an administrative adjustment request with the IRS. You can then push out that change to the partners on a Form 8986, and they then take that and use a Form 8978. This is wonderfully technical, and I will admit to you that when you saw me looking down, I was looking up those form numbers. That they then recompute the tax that would have been paid in the year of the adjustment, but include it in the year that received the push-out notice. So for example, if you were going to change a 2018 partnership return, you would file an AAR. You would then provide with the partners with an 8986 in 2020. They would take that and use the Form 8978 and compute the tax as if it were due in 2018, but pay it with their 2020 return. And if you're in that situation, you definitely need to hire an accountant. I doubt that Tax Act or TurboTax have quite gotten caught up on that. But those are all new procedures. We haven't done it yet for anyone, as far as I know. And so people are still learning this on the fly.
Are 3115 forms allowed, or must we amend 2017 and 2018?
It depends what you're asking for, but I'm assuming it still relates to bonus depreciation. So Assuming that we're not talking about amending a partnership return, you're just talking about changing depreciation methods. If you only use the depreciation method for 1 year, you can just change it automatically. If you've used any accounting method, including depreciation, for 2 or more years, you have to file a 3115, but it can be an automatic method change.
Questions separately are profit sharing contributions into plans like solo 401ks for sole proprietors extended to July 15th? The answer is yes. Mike Sacco, where borrowers, employers can choose which 8 weeks they want to count towards the covered period. Does this 8 weeks have to be consecutive 8 weeks? Or do we have the option to count 5 weeks during the period from February 15th to say March 15th and 3 weeks from the last 3 weeks in June? Great question.
Yeah, no, it's 8 weeks from when the loan, it's 8 weeks from the date the loan is originated.
Also, Mike, on the CARES Act, small business interruption loan, can a company use multiple affiliate companies to apply, or just the main company?
Well, you're talking about which loan? You're talking about the Paycheck Protection Program?
Well, the question
Good question.
CARES Act, small business interruption loan. Can a company use multiple affiliate companies to apply, or just the main company?
Well, there is, the SBA has affiliation rules where they could take companies that have, common ownership and also control, and they could group them together for the sake of the 500 employees. But if they're talking about the economic injury disaster loan, they can apply, but the SBA typically would group together or affiliate the entities on the common control or same ownership.
And in line with that, this person is asking, is there a preference in which loan to apply for versus the EIDL?
Yeah, I think it just makes, it depends on which loan makes more sense for you. I mean, if if you're a company that doesn't have a lot of payroll, or you're a company that doesn't necessarily care if the loan is forgiven and you want to borrow up to the $2 million, and then you have to really look at both loans. We have a comparison on our website that shows the two comparisons of each loan and what the different, who's eligible, the interest rates, the terms, the forgiveness concept, personal guarantees. We have the comparison. So if you go on the Friedman LLP website on our coronavirus page, and you'll see the comparison of the two loans, and you can really see which loan fits best for you.
Right. One of the things to realize is, and Mike pointed out, the SBA's affiliation rules, those are not like the IRS related party rules. They tend to be a little more, shall we say, loose. So they turn not only on overlapping ownership, they turn on concepts of control. So does one company control the other? If they have, and control can be positive or negative. So it might be a situation where the same person has veto rights with respect to all the companies through a board of directors. So even though you might say, well, they're not all owned by the same people, they're not all necessarily managed, somebody might have negative control over all the companies. So, it's really not possible to describe in detail exactly how the affiliation rules work, because there's no bright line tests. And they weren't designed for a situation like this, where you have tens of thousands of companies coming in and applying for loans. They were designed for, a county is hit by a tornado, where you might have an area that's affected by a hurricane, or you might have other economic injury, or other, just where you might have, a small business program where they're just trying to encourage development. They weren't designed to deal with a crisis of this magnitude. So my guess is that there's going to be, it's going to be difficult for the banks who are administering these loans to determine necessarily when an applicant trips over affiliation. So they're probably going to look mostly at the ownership rules, but there are these other components of the SBA affiliation rules that are much harder to list and interpret and create a bright line test for.
Is there a downside? If you think you can qualify for both loans and you're not sure which one is best, why not apply for both?
Yeah, you can. You could apply for both. It won't hurt you. You would just not be able to, if you ultimately, end up with both loans and you're approved for both loans, you have to combine them. You won't be able to carry both separately.
Okay. If I owe back taxes, does that make me ineligible for this program? If so, can I pay them? Should I pay them before submitting the application?
Well, assuming you're talking about the Paycheck Protection Program, there's nothing in the statutory language that talks about owing back taxes. In fact, there's nothing in the program that even talks about the fact that you may have other sources of credit or you may have other liquidity, unlike other SBA programs where you have to look and they look when they're underwriting the loan, could you get a loan elsewhere? Here, there's no requirement that you be able to get a loan elsewhere or that you don't have appropriate liquidity in your own accounts. And there's nothing in there that says you have to be current on your taxes.
So, Mike, if your income exceeded the phase-out threshold for the 1,200 and the 2,400 grants in 2018 and 2019, but it's not expected to exceed that in 2020, how do you go about receiving the immediate incentive dollars?
The IRS is in the process of trying to figure that out, and they're going to be putting guidance up on their irs.gov website. For most people who suffer a diminution in income in 2020, because of the COVID-19 virus, their expectation is that their income is going to be lower. So there will be guidance on the IRS website. They put out a notice yesterday, and so expect that. Go back and check irs.gov in the next couple of days. Not only will there be guidance on that, there's also guidance on, for example, if you've never given the IRS your bank account before and you want to have them direct deposit the payment, how to give them your bank account information, or if the bank account that they have is no longer your current bank account. And you want to update that, then you can do that on the website, as you will be able to do that on the website as well. Similarly with changing addresses. So I would suggest if you're in any of those circumstances, go to irs.gov and keep following that over the next few days. There'll be opportunities, presumably, to provide updated income, so that you may be able to qualify for the check. Certainly there'll be updated income on how to tell them about your bank accounts and your address. And by the way, if your income was higher in 2018 and lower in 2019, and you haven't filed a 19 return, file it now, to get that information in front of them. Unlike the Paycheck Payroll Protection Program, I forget what to call it these days, the money for the stimulus rebates is not limited. So, they'll be making those payments throughout 2020. And even if you don't get a check, but it turns out by the end of 2020, you qualify, when you file your 2020 return, you'll be able to get a credit against whatever taxes you owe. If you don't owe any taxes, it'll be a refundable credit. By the way, if you weren't required to file a return because your income is too low, or you just receive Social Security and you don't have to file a tax return, at that same place on irs.gov, there will be a simplified tax form to fill out that will enable you to give the IRS the information necessary for them to send you a stimulus check as well.
So to summarize that, there's going to be a true up in 2020. If they didn't send you enough money for one of those reasons you just spoke about, they'll send you more in 2020. But what if they sent you too much money?
In the past, when they've done these things, if they sent you too much money, you don't wind up paying it back. It's just, a gift from Uncle Sam.
So heads you win, tails you win.
It's the only time with the IRS that'll work out.
Let's see. Mike, does the CARES Act cover payments to creditors like accounts payable? And are these loans forgivable? Does CARE cover repayments of debt? And are loans for these payments forgivable?
You want to take the mic? You want me to?
Okay, good, Mike.
He just
I
said,
can take it.
I don't
I mean,
know. I don't know who he's talking to.
I'll tell you what, I'll answer it and then you can chime in.
Okay.
So the money that should be used to pay, the money from the loan forgiveness loan, the Paycheck Protection Program, those borrowings should be used to pay payroll, rent, utilities, insurance, group health benefits that are employer paid premiums and health benefits. Like we said, the retirement benefits, but we're trying to still get clarity on that from them. And then also interest on mortgage payments, not principal, but interest. That's what it's earmarked to be used for.
Right. And so if you use it to repay a loan, or you use it to pay, other payables for, inventory, for example, that's fine, but that portion is not going to be forgiven. So you can use it for that, but it's not going to, the only amounts that are going to be forgiven are the amounts that you spend in that 8-week period of time on the approved costs, wages, retirement benefits, health insurance, mortgage interest, rent, and utilities.
Right.
Mike Sacco, someone is asking live right now, is there enough money to go around? Or is it imperative to get it out this week, to get out at the front of the line?
Yeah, I think it's imperative to have conversations with your banks as soon as possible, to talk to them about when the application process is going to be available to them, how it's going to be available to them, and also, what they could start gathering to have ready to be submitted. And again, some of the banks I know are still determining whether or not they're doing it. So if that's the case, if you have 2 banks, talk to both of them. But either way, you need to start preparing for the application process now. As far as I know, there's no application available right now, but they're going to be available soon. And when that happens, you want to get yours in as soon as possible, because I do believe the money's going to run out. I mean, there's going to be every company that we know is applying for this.
And one thing to be careful about, most of the banks are only dealing with their existing relationship customers. We're not aware of, really of any banks that are taking new customers just for this loan. But what we are aware of is that there's a lot of scams out there. There are people, as there are in any, terrible situation, who, try to take advantage of people who are suffering. And so they are reaching out to companies and saying, give us your payroll information, give us your banking information or whatever, and we'll get you a loan. So be very careful what you do with your information. Be very careful that you know who you're dealing with, because there are scams out there, and you don't want to fall prey to them.
Alan, another question just came in. Is it correct that New York and New York City have extended first quarter estimated tax payments for both individuals and corporations to July 15th?
So New York State has certainly extended. New York City has not extended its first quarter payment. What they've done is they've given a 30-day reprieve for penalties. Interest will still be due dating back to the original due date. So the extension really is only for New York State at this point, not New York City.
Are you talking about corporations or both?
Talking about, so anything for New York City right now.
Okay, I'm just wondering how mechanically that works, because the New York tax return covers both New York State and New York City.
That's right. So it's really the estimates. I think that was the question was for the estimates there as to when they were due.
Right.
And I'm thinking more in terms of like a UBT filing or a New York City corporate tax return, business tax return. Those obviously are separate filings and would have their own estimates that would be due.
Mike Sacco, another question on applications. I submitted my application for an EIDL loan directly with SBA. Good. Do I also need to submit a separate one for PPP? If so, how do I do that? It seems it might need to be done with a lender. If so, the lender match site doesn't seem to be working. So what would you suggest we do to get a PPP loan?
So yes, the EIDL loan is directly with the SBA. The link is on their website for the application. That's the EIDL loan. Again, for the PPP loan, you have to contact your bank and see if they're going to be administering these loans. If they're not, then you have no bank that's administering these loans. then you're going to have to stay tuned on their SBA website, and they're going to have to put out a list of banks that you can apply to. It's just as of right now, I don't believe that link is up under the PP. I know they're working on that webpage, so I know it's not up there yet. But the idea is if you go to your bank and try to use your bank, and most FDIC banks are going to be hopefully participating.
A question that has just come in: will liquidity of an organization be considered for the CARES Act eligibility?
Not for the PPP loan. No.
Yeah.
Right. Right. Mike Sacco, while SBA loans should be requested on SBA website, it is not clear how small companies are supposed to apply for the payroll protection loans. Who are the lenders? What are the application windows open, online or in a branch? Very
So I'm
similar.
sure I'm sure it's going to be online, and I'm sure it's going to be through your bank. That's an FDIC insured bank. Hopefully they do it. They participate. If they don't, then I'm sure the SBA is going to put out on the Paycheck Protection Program webpage, participating banks that you can get in touch with.
One of our listeners has asked that they would like us to recap that the calculation, the payroll calculation for average monthly payroll.
Sure. So the Act offers a loan up to $10 million, right? It's based on a formula, which is essentially 2.5 times the average monthly payroll incurred within 1 year period before the date on which the loan is made, plus additional costs. And the additional costs are the insurance group health payments by employers that are made, retirement payments made by employers. Right now, if you want, right out of the law, it's basically salary, wage, commission, or similar compensation, cash tips, vacation pay, and sick family leave, unless you took credit under the Family First Act, severance pay, health insurance premiums and group healthcare benefits, retirement, employer retirement benefits paid, and also state and local taxes assessed on the compensation of employees that the employer paid. So you take that all, add it in, you go back to 12 months, you basically divide by 12 to get your average monthly, and then you multiply that by 2.5. And that's an estimate of what your loan amount should be.
And it's gross compensation, not net of withholdings.
Correct.
What if a laid off employee refuses to come back? Can a replacement hire be included in the FTE count as of June 30th, 2020? And the second part of the question is, will the laid off employee be disqualified from unemployment? Not sure about the second one. First one, I think a replacement hire can be included. Is that correct?
Yeah, for the headcount, it would be.
The headcount.
For the decrease in the wage part of it, I think as long as they're above the 25% reduction in total, then they would be fine. But I think for the headcount part, you could replace it just going by average headcount, not individual employee. But on the second test, which is the wage test, it's going to look at individual employee compensation. And if you're reducing that by more than 25%, then it could impact the forgiveness.
Alan, can an LLC members apply for New York State unemployment insurance if their business was shut down or significantly reduced due to the pandemic? These LLC members are active in the business, but traditionally receive guaranteed payments since all their income was self-employment income.
So the answer is yes. And that was the federal change now, is that self-employed can apply, whereas previously they didn't qualify. The question becomes, how is the compensation or unemployment determined? And that's something that we're still waiting for guidance from the Labor Department. As I think I noted earlier, New York right now is indicated on its website just to go ahead and fill out the application online. So this way, at least it's in process. And then once the calculation or the determination is out there, they'll go forward in being able to get people that unemployment.
A participant is asking, can you define the specific payroll reports required? I would assume that's for the PPP.
Yeah, I mean, we anticipate that the application process is going to, and again, this is not written anywhere. We're anticipating what the banks are going to ask for in the application. So I would have ready your payroll reports for the previous 12 months, any payroll tax filings for the previous 12 months. I would have any documentation showing your health insurance premiums, employer paid, group health benefits paid, and retirement plan funding paid by the employer. I would have all that ready to go in case, just have it ready to go in a folder in your computer. And when the application process comes about, you'll have it ready to submit.
I'm going to give you guys a little break. I'm going to go over an example or two of what people have to think about as to which they want to go for. If they want to go, this is a very common question. Do I want to do the paycheck protection loan, or do I go for the employee retention credit? Which is better for me? And as Mike Greenwald indicated earlier in the presentation, there's computations and there has to be an analysis done. But I'd like to give a couple of examples that I think will clarify things. So the first one would be, let's say we've got Sandy's Sandwich, has 50 employees, all with an average annual salary of $20,000. So Sandy can borrow 2.5 times monthly payroll, as Mike Sacco just mentioned, and that comes out to $208,333. You'll have to trust me on the math. If Sandy maintains employment levels, the entire $208,000 can be forgiven. However, if she opts for the employee retention credit, she'll get a refundable payroll tax credit equal to $250,000. So assuming many of the other conditions are met, Sandy will find that the employee retention credit is more advantageous than a Paycheck Protection Program small business loan. So you can't automatically say that a forgivable loan is always going to be better. Let's look at a second illustration. Erin's engineering service is similar to Sandy's, except Erin's employees have an average salary of $80,000. In that case, the maximum loan amount is 4 times larger, or $833,333. All of this amount may be forgiven if there are no layoffs. The employee retention credit's the same $250,000. Assuming other conditions are met, Erin will find that the Paycheck Protection Program small business loan is much more advantageous than the retention. Mike Sacco, if layoffs have already been made, how does that affect the ability to have the loans forgiven?
I think you have to look at, you have to look at the forgiveness calculations and kind of, do a test and see what you would need to do to make sure that your loan is fully forgiven. So you can, the formulas are there. You can look and see what headcount you would need to bring it up to from what you're at now in order to not be penalized with the forgiveness. And then and the same thing goes for your wages. You have a time period to cure it. So it is possible to cure this. Even though you lay people off, you could bring them back, or you could bring salaries up to a certain level, and still qualify for the full forgiveness, even though you have laid people off. But I think it's important for companies to go through the calculations and see how it would affect their forgiveness.
Alan, can we wait until July 15th to file an individual extension to October 15th?
The answer is yes. July 15th is the new April 15th due date for most states. New Jersey is still one of the few that are holding out hope. But I think eventually most states will come around. There's a lot of e-filing issues. So for somebody like a New York resident, for example, yes, July 15th is the new due date.
Michael Greenwald, we have a few different entities, some with less than 500 employees. Will common ownership cause them all to be treated as one for the CARES Act?
Well, certainly, if one group of people own all of the entities, then typically the SBA would treat those as all affiliates for purposes of determining whether there are more than 500 employees. So absent the SBA relaxing their affiliation guidelines, again, the statute doesn't, except for restaurants, hotels, and certain franchise businesses. I would expect that they would all be considered one. Now, again, Mike Sacco mentioned earlier that there is on the SBA website a table that goes through specific industries, and the list is actually referred to as the size standard used to define small business concerns. And there are certain industries where more than the size standard for SBA loans is more than 500. And that would be the case for these loans as well. So for example, just to pick one, if you were a textile product mill and you made carpets and rugs, the employee count is 1,500. So your employee count for purpose of this loan would be 1,500. If you made footwear, it'd be 1,000. So depending upon the industry that you're in, this alternative employee count might be helpful. But in terms of
Right.
affiliation, go back.
I'm trying to clarify something. That's manufacturers, right? Not an import distributor of
Right. No, that's
or manufacturing.
That's manufacturing, and it all goes by the NAICS code, which is an industry code. So if your industry code matches the number on that table, you get that higher count. So again, we don't know whether the SBA is going to relax the affiliation rules, but if you had one group that owned 5 companies and each one had 200 employees, you're going to be treated as if you have one affiliated group with 1,000 employees.
Mike Sacco, very practical question. Once I receive the funds, how will the SBA know how I spend the money? Do I have to keep a separate account and write checks from there?
What's going to happen is to get your loan forgiven, you're going to have to show detail of the proof that you spent money on rent, payroll, insurance costs, up to that amount that you borrowed to have it forgiven.
And there are going to be reports. I mean, there's provisions in the statute for reports that you're going to have to file, presumably with the lender, documenting what you spent the money on. You're going to, and remember, you don't just automatically get the loan forgiven. You have to request forgiveness. So there are going to be reports that you file with the lender, and then the lender is going to presumably review them and issue some documentation that the loan is forgiven. But it's not automatic. I spend the money, I get the loan forgiven. You actually have to request forgiveness.
And Mike Sacco, second part of that question, can you take the PPP loan and wait to use it to meet future payroll needs once your business is back up and running?
I believe you have to use the money in the 8 weeks from when you take the loan.
Right. Mike Greenwald, do you know, how does this apply to employees of churches and religious organizations, especially clergy?
Well, the PPP loans are only available to 501c3 organizations. I'm not an expert on not-for-profits, but my understanding is that most religious organizations are either are or are deemed to be 501c3s, so they would be eligible for it. Clergy themselves, I wouldn't know the answer to that. But in terms of the entire world of tax-exempt organizations, the only ones that are eligible for the PPP loans are 501c3s, 501c17 veterans organizations, and tribal businesses.
We have somebody who's actually in the process of filling out an EID loan application. Now, the loan application asks for gross revenues for the preceding 12 months prior to the date of disaster. And that person has not filed a return, does not have all his revenue calculated, and is asking, can he use estimated revenue? I would think yes.
Well, yeah, but for which period is he using? Are they using the estimated revenue for?
The 12 months prior to the date of disaster.
Right. So if there's a period in there that you haven't fully, if you have to make an estimate, but by this point, if what are they defining as the date of disaster on that in that application?
Yeah,
I'm not aware.
Can't tell from the question.
I'm not sure.
Right, can't tell from the question. I am looking at questions that have come in. We have 284 that have come in the last hour and a half. So I'm trying to pick some of these out that I think will be of general application to our listeners. Again, I think this is a duplicate, but we didn't define what a PEO is. And we used the term PEO when we were talking about the wages and the payroll calculation. Could somebody please give a definition of PEO?
It's a professional employer organization. In other words, essentially, you use them, a lot of companies use them to provide all the benefits for their employees, handle the payroll and such, but they're still considered employees of the actual business, not of the professional employee or organization itself.
Is there a difference between the criteria applied for use of the paycheck loan funds versus the criteria of the spend to be met for the loan to be waived?
Loan to be for the loan. Are they trying to compare the two loans? Say that question again.
Yeah.
Sorry.
Is there a difference between the criteria applied for use of the paycheck loan funds versus the criteria of the spend to be met for the loan to be waived?
So for the loan to be waived, you need to spend the money on the paycheck loan for rent, utilities, payroll, insurance. Those are the main ones. If you don't spend it on those things, it won't be forgiven.
Yeah, you can spend the money on anything, but the amount that's going to be forgiven is going to be determined by spending in those defined categories: payroll, retirement benefits, mortgage interest, utilities, rent. If you spend on other things, those other expenditures are not eligible for forgiveness. So, for example, you get a $10 million loan, and you spend $10 million to retire other debt or to pay for inventory. That's fine, but none of that loan is going to be forgiven.
Question regarding unemployment, probably for you, Alan. Unemployment for gig workers, interpret that as Schedule C. How handled when X percentage of your variable self-employment income is lost? So I guess, the example would be somebody makes $100,000 and now they're only making $40,000.
Yeah, so again, it's a good question, and it goes back to what we've been saying before. Typically, these individuals were not eligible for unemployment prior to this new federal bill. So the advice is to file, and once we have guidelines from the feds, we'll know how to compute that. Likely it'll be based upon the net income, is how I would think it will probably turn out for Schedule C individuals, but stay tuned, apply, and it'll all be worked out.
Right. Mike Sacco, a number of people have written to me that you're coming in with static. I hear static, and you're probably at the end of your battery or something on your computer. So you're done for today.
I apologize.
Yeah,
Is it still
yeah.
staticky right there when I talk?
Yes, a lot staticky. And a
I
number
apologize.
of
I don't know
people
what
are
it
sending
is.
me messages. So take
Should
a break.
should I mute it?
Yeah, mute it. So Mike and Alan, we'll handle the rest of our 5 minutes that we have here, try to cover as much as we possibly can. Does the Paycheck Protection Plan only apply to companies where revenues have declined?
No, it only applies to companies with 500 or fewer employees. Other than that, there's no requirement that you actually have suffered any economic loss.
And although we've answered it, it's important, let's do it again to clarify it. If employee makes greater than 100K, are they eligible for a paycheck for up to 100K or nothing at all?
Our understanding, and again, there has been a lot of confusion about this because, with apologies to Congress, there's a little bit of inartful drafting that went on. They were up late too. The way we interpret it and the way most people are interpreting it is that you include all employees, but the maximum amount of compensation that you include in the formula is $100,000 per employee. So if you have someone who makes $101,000, you include $100,000 of it. That is our understanding of the way it will work. The other important thing is that if you have employees who make in excess of $100,000 and you want to cut their compensation, you can do that without that being required to be restored in order to get the full forgiveness on the loan. The wage or the compensation reduction portion of the forgiveness only applies to employees whose compensation is $100,000 or less.
Another topic we've touched upon, but it's important for sole practitioners operating as an LLC. So I guess that'd be a single member LLC. With the owner being the sole employee, I assume the 1099s accumulated will be used for the salary component. How will the forgiveness of the PPP loan be determined for this situation?
Well, I don't think it'd be the 1099s. We're assuming that for a self-employed individual like you're describing, that it's going to be based upon, what their net income was. So let's assume that their net income was $100,000. As you said, they're going to get a loan of about $20,000. There's nothing in the language of the statute that really talks about the forgiveness formula with respect to that person. So there's going to have to be some additional guidance that comes forward on that. But if you think about it, essentially they pay themselves. So during the 8-week period, they need to pay themselves $20,000. But right now, that's a ridiculous concept. But right now, there's no specific guidance on how loans to self-employed individuals will be forgiven.
We keep getting questions about the $100,000 and that one person writes in that another accountant told them that if somebody makes over $100,000, they're completely out of the equation.
Yeah, we've heard that too. That's not how we read the statute. Again, reasonable minds can differ, and ultimately we're going to be getting guidance from the SBA. They had 15 days from the date the bill was passed, which was last Friday. So all that will be clarified, we hope, when that guidance comes out. But we've seen that as well. But our interpretation and the interpretation of most of the accountants and attorneys with whom we've consulted and whose written material we've gotten, and believe me, we've gotten an awful lot. We've collected everything everybody else is saying, and the overwhelming consensus, if you're willing to go, I would say it's at least 2/3 and maybe more than 3/4 think that the right answer is you count everything up to $100,000.
I think this is going to be our last question, and it's a unique one. If the loan is forgiven and the salaries are deductible, then isn't that a double benefit?
Yes, it is. Unless some guidance comes out from the IRS that says you can't deduct amounts paid with the benefit of a forgiven loan, which we don't anticipate and nobody's mentioned. And certainly I'm hesitant to suggest that that's a possibility. Right now, our assumption is that you get the money from the government, you pay everything that is a forgivable expense is also a deductible expense. So in essence, you get $10 million from the government, you spend $10 million, you get that $10 million loan forgiven, and you get $10 million of tax deductions, which let's assume your average tax rate is 40%, state, and if the states allow it as well, you would get $4 million of tax benefit. So yes, there is an additional benefit to that. And I'm not sure that was unintentional.
And, we've been using the term forgivable loan, but one thing we haven't mentioned is the states. The states, Alan, we don't know for sure they're going to go along with it, and they may tax it.
That's for sure. It's certainly an open question as how the states are going to deal with this stimulus package and the funds that are coming in. Remember, after all this is done, they're going to be starving for cash as well. So it's yet to be seen as to what they're going to do and how they're going to treat this money.
And in fact, our